moment feel like quite a difficult exit opportunity. And I think the data suggests that.
Yeah. And, we typically don't comment on deals and exits specifically. So I think you have to kind of read the news about Galderma to kind of try to get a picture of what's going on there. But what I can say is that the company is developing really well. We've got a great management team, and we're working to continue to drive innovation, working with making the packaging and the products even more sustainable, doing add-on acquisitions, et cetera. So as long as we don't sell a company, then we own it, and when we own it, we want to take responsibility for making that company better, stronger, faster, more sustainable every single day, and ultimately then more valuable for all stakeholders, including the shareholders. So that's what's happening in Galderma and many other companies. And the exit market overall is more complicated. Like I said, it's bifurcated. There's still deals being done, like in BioRetainer that we did the other day, or software companies, healthcare companies, companies within the energy transition, which is super interesting. That transition has to happen. Private equity has a real important role to play, I think, as responsible owners in driving that kind of transition. So there you'll continue to see deals, but somewhat fewer because valuations are a little bit more hard to find. On the more complex assets, I think it's going to be very quiet for some time. And the IPO market, who knows if it's if and when it's going to open up this year. We hope it's going to open up after the summer if the world stabilizes. Unknown period, we're not passive buyers. That's why beginning can actually be hands-on.
Broader question of exits, like there's a crop of companies that were bought, say, between 2018 and 2021, where if you look at the average valuations that private equity was paying, it's sort of well above the historical average. Mm-hmm. I don't have the Galderma numbers to mind, but I do high multiple deals in that period. How do you think about that vintage of companies at the moment? Because there's a thesis out there in the market that actually valuation multiples won't reach that level again, for quite a long time because of where interest rates are going, which has a kind of mechanical effect on compressing valuations. And I suppose just to sharpen that question a bit, if you decompose how private equity has made money over the past few decades, a big chunk of that has been what we kind of in the business call multiple expansion, right? Where you sell a company for a higher multiple of earnings than you bought it for. Is that multiple expansion, is that off the table for that vintage of highly valued acquisitions? And what do you have to do to make up the difference if it is off the table?
Well, again, if you have a crystal ball, we would all know. But the way we thought about it over actually a long time is, we felt that valuations have been pretty high since 2014 or something like this. So in our acquisition plans, we've generally been, expecting lower valuations when we sell than when we buy. Actually, in the most previous fund generation, I think it's 4 EBITDA multiple points, so quite significant, and on average. So what that means, actually, more fundamentally, is that it means that our value creation plans need to be even more ambitious and even more solid. And to give you an example, we paid quite a high price for what was called Evidensia at the time, and then IVC right afterwards, which was an add-on acquisition, creating IVC, our veterinary care business. We bought that first company for something like 300 million or so pounds.